Thank you for joining us today. I'm Chris Hastings, one of the founders of Panoramix, and today we are going to talk about billing in your client's best interests, with several permutations of what that means. Before I dive into the details, I must keep the legal team happy with the following disclaimer. Sapphire Software Services, Inc., a Minnesota corporation, develops and markets Panoramix for financial advisors for the convenience of its licensees. Sapphire does not directly employ compliance experts, and its employees are not authorized to dispense compliance or legal advice. Certain practices in this webinar are designed to enhance the advisor's ability to withstand an audit or a review, but you are responsible for engaging your own compliance experts to establish your own requirements and controls. So sorry about that, but legalese is legalese. So at Panoramix, we focus on billing and performance reporting. That is not to say we don't do anything else. We certainly do. We offer a host of other reports and reporting things such as Schedule 13Fs, RMDs, realized and unrealized gains, income forecasts, risk analysis, and more. We have also a decent CRM, a client portal, and some basic rebalancing functionality. In addition, we are ranked #1 in customer satisfaction 2 years in a row at the annual T3 Advisor Survey. So why not check us out if you are looking for a system for billing and performance? And at Panoramix, we have come up with 5 hard and fast billing rules, which we will get to as the presentation moves along. But to start with, here's rule #1. Just keep it simple. Do not overcomplicate your lives trying to be fair. If you give me a set of complicated rules that you consider to be more fair, I will give you a market scenario where they actually aren't. Or on the other extreme, don't try to conjure up some complicated rules to get as much money from a client as you think you can get away with. We have seen both of these extremes with our client base. And positive note, most advisors are actually trying to be more fair rather than not. But at some point you will get audited, and the more complicated your billing is, the harder your audit will be. This is not something to overthink. Just keep it simple. Advisors ask us quite often, what is the best way to bill? And so that's a tough question, but there are several factors that go into deciding that. There is no one size fits all. The first question you probably want to ask is, what exactly are the criteria for best? It needs to be some sort of combination of easy and fair. I think we can agree upon that. You could, for example, bill all of your clients $10,000 a year flat. That's certainly very easy, but it's probably not very fair. You could bill your clients based on their average assets under management and assign a percentage to each holding based on how much input you have and on the overall decision to hold that security, as well as the overall performance of that security against some sort of reasonable benchmark. Combine that all together for some sort of overall billing factor and strategy. That sounds like that might be fair, but it certainly is not easy. You must balance what is best for your clients and what is best for you, and what is best for auditors. All three want easy. Everybody wants easy. So that should drive you to some form of simple when deciding on your billing. But fair is in the eye of the beholder and can be elusive if you start getting complicated. Sometimes people will equate easy to lazy, and there's certainly going to be cases be made for that. So at some level, fairness needs to be considered. Ultimately, however, you're going to have to explain and prove your billing both to your clients and to auditors. Therefore, make sure whatever you decide, whatever billing you're going to do, is based on numbers and math that you can easily explain and easily prove. Finally, make sure you have a good billing system, and that should be Panoramix. It is going to be your best friend during an audit. So here are a couple of parameters you need to consider when setting up and deciding on a billing strategy, and also when setting up your ADV. We will get a bit more in depth with each of these as we go. A couple questions are you going to bill in advance or arrears? Do you want to bill monthly, quarterly, semi-annually, annually? Do you want to set up fee schedules? And if so, how do you want to do your tiering? How do you want to determine the value of the account in order to bill? Do you want to use the end of period balance, an average balance, or something else? Do you want to bundle your fees into a single management fee or break them into parts like financial planning, asset management, tax advice, etc.? Just make sure that whatever you do, you have a good billing system to take care of all of that for you. Which brings us to billing rule #2. With all the considerations we just brought up and parameters involved, you might want to get clever and really tailor your billing to each client. What we will say is cleverness never ends well. Just keep it simple. Having a great billing system like Panoramix, which can help you handle a multitude of one-offs and almost any sort of billing that you can imagine, and you might start to think that maybe you should use some of that and complicate your billing. Don't. Just because you can do something doesn't make it a good idea. So you need to specify whether you're going to be billing for the next quarter or month or the previous quarter. So whether you're billing in advance or in arrears. Either is acceptable, but billing in arrears probably looks better for your clients. You're actually saying, here's a bill for what I just did for you rather than please pay me for what I'm about to do for you. However, not every advisor is in the financial position to float their receivables. Just remember that when billing in advance, you are estimating what's going to happen over the next billing period. And to be more fair, you should adjust that estimate somehow to reflect what actually did happen. When billing in arrears, you know what happened, so you have a much better basis for billing and an ability to be more fair. The other big difference is that it happens when a client leaves. If you're billing in advance, you must refund some money. Some states are very strict about the timing of that. So if when billing in arrears, you have the option to bill for the partial period that you haven't billed them for, so it's a little bit less strict. But regardless of your decision, Panoramix is there for you to help you guide through the process, especially cancellations, which can be tricky. Timing and frequency. Should you bill quarterly? Should you bill monthly? Should you bill an annual financial planning fee and a quarterly management fee? There's really no perfect answer for everyone. One question that you can ask is, do you think your clients will be more focused on being reminded that you charge them fees, or will they be more focused on the actual amount of the fees? So if it's the first group, they're more focused on being reminded of it, then you should bill less often. If it's the second group, which is more focused on the actual value, then you should bill more often. So figure out, or you could actually try to figure out which clients want to know which and try to segment your clients based on that and bill some clients monthly and some clients quarterly. That, however, would not be simple, but it demonstrates that there are some options available in general that Panoramix offers, as well as any other billing systems offers, that allows you to get complicated, but doesn't mean you have to. Perhaps one of the more complicated questions that we will ask is, how do you want to tier? It's complicated because the terms for the two options are neither standard nor intuitive. If, for example, you have a tier that goes from $0 to $1 million at 1% and another tier over $1 million at 75 basis points, and I have a portfolio value of 1.2 million, then the question is, do I bill 1 million at 1% and 200,000 at 0.75%? Or do I bill the whole 1.2 million at 0.75%? So that's the question for tiering, and those are called different things. The first one is called a blended rate or a step-up tiering, or true tiering sometimes. The second is called threshold billing or flat billing, which is you're billing the entire amount one rate. A case can be made to do it either way. If account values are going up in the wealth accumulation stage, for example, the client will perceive the non-blended is a better deal. If the account values are going down, such as when you're taking planned distributions, then it might not look like such a great deal after all. So a blended rate would certainly be more fair, but multiple accounts and householding can make it very confusing. So again, you're kind of choosing to trade off between easy and fair. Our plug again, regardless of what you choose, Panoramix is there for you with our award-winning service. Now that you've made the decision on how many bips you're going to charge, now I have to figure out what I'm going to use for a basis for the fees that I'm going to charge that against. There are multiple ways to put a value on a portfolio for billing purposes. They really boil down to three buckets: the actual value of the account on some day, or some sort of average value of the account over a period of time, or some sort of combination of weighted flows, account values, and or averages. So then a lot of that depends on really whether you're billing in advance or in arrears. If you're billing in advance, as we had said earlier, you don't really know what is going to happen. You are estimating. The only real value you can use for your portfolio is the account at the start of the fee period. An average balance makes absolutely no sense here, so you can rule that out. So you will be billing for the next period based on the value today. And then you have the option of at the end of that saying, I want to look back to the prior quarter and get cash flows and adjust, or do a true up, as the accountants would say. And that is certainly an option if you're billing in advance. If you're billing in arrears, you can bill either on the ending balance of your portfolio or some version of an average balance. Since you know what happened, you have a bit more information to base your billing and make it more fair. An average balance is more fair, but there are many ways to determine an average balance, which we will cover in detail a little bit later. Finally, do yourself a favor and prepare for an audit. Whatever you decide, make sure you can prove it. First of all, let's talk about what does that mean. You are not the master of your domain, the custodian is. Does this kind of disclaimer look familiar to you? Sapphire Financial does not have custody of your assets and relies on third-party custodians and vendors to provide pricing and valuation data. The firm has made reasonable efforts to obtain data which it believes to be accurate, though the firm has not verified these values and prices by these third parties. And I'm going to insert here, by the way, unless you are audited, in which case you need to be. In any case, as we are not the custodian, we are not liable for any damages due to inaccurate data. Please cross-reference these numbers, blah, 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 blah. So this is probably a standard disclaimer that you have on reports, or you should, and all of you have some sort of version of this on your reports. However, when you're being audited, and it will It'll be a when you're audited, not if. You will be asked to cross-reference all these values and pricing with your billing system comes up with the custodians, regardless of what you put on disclaimers. So when you set up your billing, make sure your rules are based on values that you can easily get from your custodian. And when we say custodian, we mean statements. But you know what you cannot easily get from your custodian? The daily balance of your account for every day for the past month, quarter, or year. It isn't available. So if you're using an average balance for billing, do not use an average daily balance. You do not have the ability to get all those numbers from the custodians, and therefore you cannot prove your average daily balance. There are far more audit-friendly methods of computing an average balance, which we will cover in the next slide. When you do run your billing, save everything to a compliance folder. Everything. Most systems like Panoramix will allow you to go back and regenerate your billing from previous timeframes, and that is great in a pinch, but you should have everything an auditor would want saved after each billing run. Do mock audits if you need to, and make sure you have what you need. So we handled, let's talk about average billing. We handled this topic in detail in our Pulitzer Prize award-winning white paper, The Case for an Average Billing, which you can download from our website at www.panoramixfinancial.com. We'll give you some of the highlights here. First of all, what is an average balance? The simplest definition is the value at the beginning of the period plus the value at the end of the period, and you divide that by 2. That's an average balance. However, that approach doesn't truly reflect the effects of cash flows in and out of the account and when they happen. Some argue that a simple mathematical average may not be in the best interests of your client. You can break out the market effects and then the cash flow effects in order to get a better average. For flows, you can remove them from the balance and then add them back in a prorated or weighted fashion based on when they happen. This will average out the flows, and then you can average out the market effects by just taking the ending value plus the beginning value minus the total flows and dividing by that by 2, and that will give you kind of what the market did. And that's an average for what your investments did that you had at the start of the period. Or you can simply use the ending value as your starting point and then work back in with your cash flows. Each of these will give you a number that is between the starting value and at the ending value. That's kind of what an average does. The benefits of any of these methods is that all of the numbers can be found and verified on a custodian statement. That is the benefit of not doing an average daily balance, but computing things with weighted cash flows, because you have those on your statement. The other method, as we said, is the dreaded average daily balance, and that's evil. Just don't use it. But not only will an average balance be more fair, it smooths out the peaks and valleys of a volatile market. If you look at 2020, in Q1, advisors had some rough time there. And in Panoramix, billing was down 10.5%. So our billing for Q1 of 2020 was down 10.5% over what it was at the end of 2019. That's across our entire book. But for those advisors that were billing on an average balance, it was only down 6%. So you can see that an average balance smoothed it out a little bit. In Q2, however, all billing was up 13%, but if you build on an average basis, it was up 5%. So the average balance, I like to think of an average balance method as kind of like a stock bond allocation. It doesn't do as well when the market is soaring, but it doesn't lose as much in a downturn. So it helps smooth things out for you. Which brings us to rule number 3. There are a lot of options. We've covered a lot of options. Just keep it simple. Another thing we want to talk about is bundling fees. In an upcoming white paper, we talk in depth about bundling fees, or more accurately, about unbundling fees. And it will be out next month, and be sure to check it out for more details. But here are some of the highlights. For the sake of simplicity, for this discussion, we will talk about separating out a financial planning fee from your management fee. So unbundling financial planning fees versus everything else. And there are 3 very good reasons to do this and 1 good reason not to do it. The good reason is clients can deduct your management fees, but not your financial planning fees on their taxes. And this changed in 2018. And if you're bundling your fees together, then technically none of it is deductible, or some undefined partial amount is deductible, but it gets into a gray area. But you can help out your clients by separating out these fees, so they can actually deduct management fees and not the financial planning fees. So, break it out, and it'll actually help your clients at tax time. Secondly, net of fee performance reporting needs to consider management fees in performance, but not necessarily financial planning fees. So other fees, like financial planning fees, do not need to be deducted when you're looking at net of fee calculation. So your fees, and some would say more fair, but certainly it's going to look a little bit better. And you'll have better transparency with your clients, because you're actually telling them more about what you're doing with your fees. Now, one of the drawbacks of that is it's complicated. It's not simple, and that goes against 1 or 2 of the rules we've talked about. But ultimately, unbundling your fees might be worth that hassle. Bring it to rule number 4, keep it simple with some informed exceptions, like perhaps unbundling fees, which we talked about before. And so you get the picture. I'll stop now with my rules. There aren't 5 rules, there are only 4. Sometimes we get asked what I would do, and we had a disclaimer that said we aren't allowed to, give you financial advice. We're not licensed for it, but I will tell you what I kind of think I would do. I like monthly because it handles larger variations better, either in cash flows or in the markets, and you can handle that more quickly. It also shows a smaller amount to your clients, and I think that is a better thing. You have to run billing more often, and that can be a negative, but if you have a system like Panoramix, that makes it a lot easier. I like arrears when you're billing because you know what you've done, and you're billing for what you've already done versus what you're going to do, and I think that is perceived more favorably and fair by your clients. I think an average balance better reflects the value of the portfolio. Even with a monthly bill, this can be better and more fair, and I think is a better way to reflect the value of the account. And then for net of fees and for tax purposes and for transparencies, I would separate out my management fees from anything else, from any of my other fees, so that deduct them and deal with them better in performance reporting. I lied. We have 5 rules. I didn't stop. Keep it simple. That is just, again, I don't think we can stress that enough. Just keep it simple and don't try to complicate your lives, and don't try to be as fair as you think you possibly can, because you're just going to get hammered in an audit. So just try to keep it simple. So if you want to know a little bit more about Panoramix, you can schedule a demo regardless of what you want to do with your billing. We are here to help you. Our award-winning customer service and training staff will work with you every step of the way to get the most out of your billing. Let us do what we do best so that you have more time to do what you do best, which is servicing your clients. If you want to schedule a demo or to learn more, please visit our website at www.panoramixfinancial.com. And with that, I thank you for your valuable time and attention today. And it was my pleasure to be part of the conversation on billing in your client's best interests. Thank you.